Eric Robertsen is here. He's Global Head of Research at Standard Chartered. Eric, thanks for your time. Just your reaction to what you've heard from Ben Bernanke there. Obviously, a very well-respected voice from the Fed and on the markets. He said the Fed basically made a mistake here, attempting to tame inflation a little too late. What's your view?
First of all, good morning, and thanks for slotting me in right after Bernanke. Look, I think his points are absolutely correct. The Fed left the start of the hiking cycle too long. They left quantitative easing in place for too long, and now they're scrambling a little bit to try and get the policy setting back to a level that's consistent with where growth is and inflation is. Our view is that they will have to sacrifice growth in the short term to try and get inflation under control. We would agree that inflation expectations remaining stable is a key part of that equation. And to that point from Bernanke, 10-year break-even inflation expectations are now back below 3% and around 2.7 for the 10-year part of the curve. So I think that's an important starting point. But we do believe that in the very short term, the Fed, as well as the other central banks around the world, have to slam on the brakes pretty hard. And that create some risk scenarios for growth in the second half of the year.
And of course, one of the key risks is recession. Is that a likely scenario in your view, Eric?
No, it's not. We do expect an economic deceleration, partially because of central bank rate hikes, partially because of the loss of momentum that we have seen in China. The surge in food and energy prices around the world is going to be ultimately demand destructive, but we do see it as a deceleration, not a recession. If you were to see a material further slowdown in China above and beyond or below and beyond what we've already seen, an escalation in the Russia-Ukraine conflict, any of these factors could be a factor that tips the economy into recession, but that's not our baseline view.
We watch it closely. You know, one of the other main things on investors' minds this week is China. We are seeing China relaxing COVID curbs now after 6 weeks in lockdown. As you can see, based on the equity market reaction today, investors certainly like the news, but how soon before the easing in lockdown starts to offset some of the economic losses that we've seen, this downside that we've seen in the economic data? Only yesterday, retail sales falling by more than 11%, for example. How soon before some of the easing up in these lockdowns actually starts to translate into the economic data?
Look, as you say, it's an important first step that we are seeing some easing of movement restrictions. But I think what people have to be prepared for is that this reopening is going to be a very slow and deliberate process. It's not going to be a quick flick of the switch and all of a sudden everybody goes back to their offices and goes back to the shopping centers. So as you correctly point out, the hit to consumer demand has been significant, and equally the hit to consumer sentiment is significant. And so I think even if we do see a reopening of both major cities as well as the smaller, more regional cities, we have to remember that they have the Party Congress in third, fourth quarter of the year, and they're solving for that. So the reopening will be slow, it will be deliberate, and that means that the economic recovery will be initially quite slow and deliberate as well.
I think it's interesting as well, analysts over at JP Morgan upgrading China tech now and other sectors, having previously called some of the stocks within this space uninvestable. What does your own equity strategy look like in China at this point, particularly if we do see economic headwinds, regulatory headwinds persisting there?
Well, look, I won't comment on the tech space, but what I will say is that if China's objective is to see an economic recovery in the second half of the year, which we all know it is, then there will have to be some easing of the regulatory restrictions that we've seen, and in some ways re-embracing the role that the tech space has to play in that economic recovery. And whether that's getting some of the technology platforms to help facilitate an improvement in consumer spending, whether it's using some of the technology platforms to facilitate an improvement in consumer demand for mortgages and therefore for home purchases, that will be an important aspect of the recovery itself. And so I think it's reasonable to expect that you would see some easing of the regulatory constraints that we've seen in place over the last sort of 12 to 15 months.
Okay, an interesting time for investors. Eric, really appreciate your analysis as always. That's Eric Robertsen from Standard Chartered live for you in Dubai this morning. Looking forward to speaking again soon, Eric.